Welcome back to another market and economic update. In this video, we'll discuss rising gasoline and diesel prices, what's driving them, and what they mean for consumers, inflation, and investors. For most Americans, the price of gas at the pump is one of the most direct ways that global events affect everyday life. With ongoing tensions in the Middle East pushing oil prices sharply higher, this is a topic that is very much on people's minds right now. This may cause flashbacks to 2022 when gas prices jumped, and for some Americans, this may even remind them of the 1970s. However, it's important to note that today's situation is quite different. Over the next few minutes, we'll walk through what's happening with gasoline prices, how to put them in context, and what rising energy costs could mean for inflation and the broader economy. First, let's look at where gasoline prices stand today. The national average for regular gray gasoline has climbed to just over $4 per gallon. That's up more than $1 per gallon in just 1 month. This is just a national average, so depending on where you live, you may be seeing prices that are significantly higher. While these prices are still below the record high of $5 per gallon in 2022, it's a meaningful increase that many households are already feeling. To put it in concrete terms, we can do some back-of-the-envelope math. If the average fill-up is about 15 gallons, an extra dollar per gallon adds $15 to each trip to the gas station. For someone filling up once a week, that's roughly $780 less in their pocket over the course of a year. For those of the lowest income ranges, this could represent 2 hours of wages for each fill-up. For the average American household, they can absorb these costs, but it does reduce discretionary spending and savings. The impact doesn't stop there. Higher fuel costs ripple through the broader economy as well, since transportation and distribution are inputs into nearly everything we produce and consume. So rising gas and diesel prices effectively act as a drag on consumer spending more broadly. Next, it helps to understand what actually makes up the price at the pump. According to the U.S. Energy Information Agency, roughly half the price is based on the cost of crude itself. The rest comes from refining, transportation, distribution, and federal and state taxes. This is one of the reasons why prices at the pump can be so much higher depending on where you live. This is also why gas prices don't move in lockstep with oil prices. There are several layers between the oil market and your local gas station, and it takes time for the market price to change and work its way through. One encouraging signal worth noting is that oil futures markets are currently backwardated. Backwardation is a technical term meaning that oil prices are much higher today than where traders expect them to be in the future. This suggests that the market views the current price spike as a temporary disruption rather than a permanent shift. It's not a guarantee of a quick resolution, but is an important signal of how markets are interpreting current events. Finally, rising energy prices have implications for inflation and, in turn, the Federal Reserve's decision on interest rates. Energy is an important component of the headline Consumer Price Index. After several years of improving inflation readings, the recent jump in oil and gasoline prices will likely push headline inflation higher in the coming months. This matters because rising inflation can create headwinds for both stocks and bonds. It also complicates the Fed's decision-making. Markets have already shifted their expectations, with traders now pricing in a greater chance that the Fed holds rates steady or even raises them rather than cutting. Historically, economists tend to view these types of energy-driven inflation spikes as temporary, since prices typically moderate once supply disruption eases. The U.S. is also now the world's largest oil producer, which provides more resilience than in past energy crises like the 1970s. For investors, the best approach remains staying invested with a well-constructed portfolio and a long-term financial plan. We hope you found these insights helpful. If you'd like to discuss energy prices, inflation, or how current conditions may affect your portfolio in more detail, please don't hesitate to reach out. And remember, healthy plan, wealthy life.